I'm Justin Goldman, CEO and co-founder of RenoFi, the renovation financing service that makes remodeling possible. Our loans allow homeowners to borrow up to 90% of the post-renovation value of their home. I'm thrilled to be speaking with CoreLogic's Dr. Frank Nothaft. CoreLogic is a leading data provider on home prices and home equity. Dr. Nothaft is a chief economist at CoreLogic, holds a doctorate in economics from the Columbia University, as we just covered, and was VP and chief of economics at Freddie Mac for over a decade. In addition, Dr. Nothaft has served as president of the American Real Estate and Urban Economics Association, board member of the National Association for Business Economics and the Financial Management Association, advisory board member of the Real Estate Research Institute, and editorial board member of the Journal of Real Estate Finance and Economics. You have been busy and accomplished. It is awesome to be chatting with you right now. All right, so let's dive in. Sound good?
Sounds good.
Okay, and I'm an interview newbie. Okay, this is not only the first economist that I've ever spoken to. This is the first recorded interview that I've ever done. So let's see how it goes. I've watched a lot. Watched some of yours. All right. So Dr. Nothaft, the CoreLogic shared their September home price report this week. Super informative. One of the key insights was surrounding the impact of continuing price rise in the housing market. The report said something along the lines that home prices year on year increased 18%, which is a big number. But also over the next 2 years, the report predicts that this is going to slow all the way down to about 0% year on year appreciation in 2023. What I'm most curious about is what is driving that expected slowdown in annual appreciation.
Yeah, it's an incredible housing market that we've seen over the past year. As you said, 18% rise in our national home price index. Now, not every single community has experienced 18% rise in home values. It varies by local market. Some markets are rising by a little bit less. Some are rising by a lot more than that, but on average, works out to about 18%. That is the biggest 12-month increase that we've seen in our national home price index since we first created that. And that was 45 years ago in the mid-1970s. So this is a real big-time increase in valuation. We can't expect to see home prices rising 18% a year after year after year, when family incomes are only rising maybe at best 3% or 5% at best year after year, because it really gets into an affordability challenge. With prices going up so much, that means for a first-time home buyer, they're going to have to increase the nest egg, that is the savings that they have in order to buy, by a commensurate amount. So with prices up 18%, the first-time home buyer's nest egg savings also has to be about 18% larger in order to be able to afford to make the down payment, closing costs, and have a little cash in reserve in order to make that transition to first-time home ownership. So as affordability becomes more of a pinch on the pocketbook for first-time home buyers, we expect to see some moderation in home buying demand over the course of the next year. So looking at the next year, a little bit less demand, and I think a little bit more inventory, a little more supply coming on the market. And between less demand, more supply, that translates into a moderation in home price growth. So 18% this past year, but we expect it to be much more modest in the next year.
Super helpful. It makes a ton of sense. You mentioned expecting some increased supply coming onto the market. Is that from just new homes being built, or is there something else driving that?
A lot of it is new single-family home building. So we are expecting single-family home building to increase over the course of the next year. Now, single-family home building, while there have been some challenges because of supply disruptions, increases in material costs, particularly for lumber, some supply challenges in getting appliances shipped to new home sites. So there are challenges out there. Still, in 2021, single-family home building was the biggest in 15 years. 2021,
Wow.
single family home building, best year since 2006. So
Wow.
we are expecting single family home building actually to rise a little bit into 2022. So that's one part of the inventory equation. I also think that there have been some older homeowners who've been sitting on the sidelines waiting to list their home for sale, partly because maybe some concerns about the pandemic and having non-household members come traipsing
Sure.
through your home. So with a large portion of the older homeowner population now vaccinated, with the pandemic hopefully waning as we get into early 2022, and with more of the older homeowner population moving into retirement, considering about where they want to relocate, where they might want to move, I think we'll see some more inventory for sale coming from that existing housing stock, older homeowners who had postponed listing their home for sale over the last 2 years because of concerns over the pandemic. So that's another part of it. There's a third, a small part of it, and that's with the borrowers, the families who've been in forbearance over the last 18 months and will be exiting forbearance. And most of them will be in really good shape to be able to continue making mortgage loans. The 18 months was a good time out for them to get their financial house back in order. Sadly, not everyone is going to be in that position. Some families who've been through a great deal of financial duress, they'll be coming to the end of that 18-month forbearance period, and they still will be challenged in being able to afford to make mortgage payments. So for that group, we'll probably see some additional homes come onto the market listed for sale, maybe a few distressed sales, but there'll be some sales inventory coming onto the market from those homeowners who've just really been financially challenged during the pandemic. So between all these different sources, we are expecting more inventory. So more supply, moderation in demand translates into a little bit slower home price growth next year.
Thank you for that. Super awesome explanation. Learned a few things just now, so that's helpful. It's a good segue actually to the next set of questions that I wanted to talk about. There was a recent NBC article that you were quoted in where you were talking about how institutional investors are buying up single family homes at a much higher rate than usual. In that article, Lori Goodman, the VP of Housing Finance Policy at the Urban Institute, was also quoted in the article talking about how these institutional investors have a leg up over the residential purchasers. And one of the things that she pointed to was the lack of renovation financing solutions in the market for homeowners, whereas obviously the Wall Street investors have unlimited access to cash. And so they can buy these homes that need some love and fix them up. We definitely agree with Lori's point that renovation finance has not been easy. That is what we here at RenoFi are solving. But it's clearly a disturbing trend, having all these investors taking these homes that should become major assets for families building wealth over their life and turning them into rental properties. And so the question I have for you is, the article talks about the possibility of government policy changes, such as the longer window for foreclosed or HUD-owned properties to be bid on by non-institutional investors. My question for you is, if you were in charge of the world and you could change the policies to try to reverse this trend and keep it more properly balanced in terms of the amount of homes going into the hands of real families versus these institutional investors, what would you change to try and reverse this trend?
Yeah, and what you mentioned, I think would be one policy shift that would help, allowing potential owner occupants or perhaps first-time home buyers having first dibs, having first try at trying to buy homes that have come onto the market as distressed sales. That could be a good policy shift to at least provide that opportunity. Now, it has been a remarkable 18 months of the pandemic, because early on, when we look back in 2020, with the tenant eviction moratorium that were in place in so many jurisdictions around the United States, it was not a good time to be stepping in as a single family investor. And it's really interesting when we look at CoreLogic data, we actually saw a drop in single family investor purchases in 2020 after of March of 2020, after the pandemic hit the United States. And in my mind, that's not surprising given the uncertainty in the housing market. None of us knew what was going to happen in the economy with the housing market. There were eviction moratoriums in place. So investors actually stepped back from the marketplace in 2020. But 2021, we just saw a real rebound. The market has turned around, especially in the second and third quarters of 2021. And we did see investors in our data really kind of step back into the market with close to a quarter of homes purchased in the second quarter by single family investors. Now, to the extent some of those investors are iBuyers, they're not investing with the intention of renting longer term. iBuyers are stepping in, they're buying the homes, they are engaging with some of the fixes, repairs, repainting, whatever it may be, to prepare those homes for resale within the next, a short period of time. So we also saw iBuyers really kind of step it up over the last several months as well. So with iBuyers stepping in with the intention of reselling the homes, those homes ultimately will be on the market again and available for owner occupants. But there is also no question that more traditional single-family investors have stepped up their game too and have acquired homes. There's a very, very strong demand for single-family rental homes in the marketplace. And the single-family large-scale investors are really trying to meet that need as well. And I'll tell you why we saw this big shift over the last 18 months in demand for single-family rental homes. It's because of the pandemic. What you get with a single-family home compared to a rental apartment in a high-rise apartment building is the following. On average, a single-family home has about twice as much square foot of interior living space compared to your average rental apartment in a high-rise building. So you get a lot more interior space, and you get social distancing from your neighbors with a single-family home compared to a multifamily home. And during the pandemic, more interior space and more social distancing with neighbors was in big demand, not just among home buyers, but among those families who rent as well. And so we did see a shift out of multifamily high-rise rental apartments in the year after the pandemic began, and looking for single-family rental homes. And that's one reason single-family rent growth has been so strong. We've seen in the CoreLogic single-family rent index that rents in the national index, rents are up about 10% over the last 12 months. And that's reflecting that very strong demand for single-family rental homes. And again, facing kind of a limited inventory because vacancy rates on single-family rental homes have actually come down over the last 18 months.
So what I'm hearing from you is, on one hand, the high level stat that you said, something almost like 25% of single-family home purchases are being done by institutional investors, might not be as troubling as it sounds, because the iBuyers are making up a decent percentage of that, and those houses are getting refreshed and then put back onto the market available. So that's encouraging. And then secondly, it also sounds like, based on what you're seeing in the data, there needs to be some more rental stock for the single family. So you don't actually see it as too big of a negative, which is good for the U.S. In terms of the trend, and I can't remember if it was talked about in the article about where you see this going, but do you see this like 25% level becoming the new normal, how things are going to play out, or is this a temporary, increase that will normalize?
Personally, I think it's just a temporary blip because there was a downturn in 2020 in single family investor activity. So I think a little bit what we're seeing here in 2021 is making up for lesser purchases in 2020. So I tend to think it's more temporary in terms of the pickup that we've seen over the last several months. There is an important point that you brought up earlier, and that's the access to the cash that's needed to make improvements to a home. And if you're an existing homeowner, you're in a little bit different place, because if you're an existing homeowner and you have benefited or experienced this 18% rise in home values over the last year, wow, that created a great deal of additional home equity wealth for you. And if your plan is to stay in your home longer term, but you realize now you need more space because now you need an office from home permanently, whereas 18 months ago you didn't know you needed that, you can consider tapping into some of that home equity that has grown so much over the last 18 months in order to get the additional cash financing that you need to make an addition to your home, to make a large improvement. Generally, what we see homeowners do is that if it's just a small cash improvement, oftentimes they may pay for that out of savings. They may not need to go and get financing for it. But if we're talking about a $50,000, $100,000 or more home improvement, that's a big ticket item. And many families don't have that amount of cash just lying idly around. And so they will need to tap into some of that home equity that has accumulated in order to finance it. Now, with the 18% rise in home prices that we saw in the CoreLogic Home Price Index, that generated on average about a $50,000 increase in home equity wealth for the average homeowner in the United States over the last 12 months. Now, again, it's not even across the U.S. If you live in a place with higher home prices or more rapid home price growth, you've seen your home equity rise even more. So, for example, California, very high home prices. Some markets have had much more rapid home price growth. The average home owner in California has seen a $100,000 increase in home equity wealth over the last 12 months, thanks to home price growth. So it does vary a lot around the country, but on average, looking across all homeowners, $50,000 increase in home equity wealth. That's really important. Especially if you're considering making in some type of major improvement, an addition to the home, updating the kitchen and the bathrooms, because now you're not just living in your home, you're working from your home. Mm-hmm. So having that home equity wealth is important. With the increases we've seen, the average homeowner in the U.S. has more than $200,000 in home equity wealth. And just so we're all on the same page, maybe I should just define home equity wealth so we're all clear on it.
Sure.
So when I speak of home equity wealth, I'm referring to the difference between the market value of the home and the amount of mortgage debt on that home. So the difference between the two, that's home equity. So when home prices go up and the market value goes up, home equity wealth increases. And that's what we've seen over the last year.
And the typical homeowner with $200,000 of equity built up is someone who's likely been in the house for some period of time and has had a chance to pay down that mortgage and benefit from this rapid increase in appreciation. We here at RenoFi are really focusing on a different homeowner. We're focusing on the recent home buyer, the home buyer that hasn't had that chance yet to build up the equity over many years. Coupled with another trend, which you probably know the stat way better than I do, but the general trend of homeowners putting less of a down payment down when they're purchasing the home, with all the different programs and with the markets bouncing back the way they have. It's never been easier for a homeowner to buy a house with 5% down or 10% down. And so those homeowners, especially in the markets that are not appreciating at the level that, the high end of the market in terms of appreciation, those homeowners is going to take a long time to reach $100,000 of tappable equity or $150,000 of tappable equity to do the types of renovations that you were just alluding to. And that's where RenoFi comes in, and other companies that are all trying to fix that issue that Lori and yourself were talking about earlier. Okay, a couple last questions here. One of the trends we're seeing in markets like California that have extremely limited housing stock is the ADU boom. And so one of the questions I have, which for those who don't know, stands for accessory dwelling unit, where homeowners in California, there's no housing stock, and so they're able to create a second dwelling unit on their property, which they can use as an office. They can use as a guest house for folks, or also even rent it out and create the opportunity to make some rental income. My question is, seems to be quite concentrated in California. Do you see this ADU boom, spreading to other states? And if so, which states do you see most likely to follow in California's footsteps?
Yeah, wherever there's a shortage of homes, especially affordable homes, we'll see kind of these additional pressures or need to find ways to, in essence, increase density a little bit in order to add additional units where previously maybe the local zoning was exclusively one unit zoning. So we saw it actually recently too in Minneapolis. So a couple of years back in Minneapolis, they decided to rezone so that areas with a one unit, one family zoning could actually add an additional unit there as well and have two one unit family units on the same parcel. So that's an important opportunity or trend that is emerging in the marketplace to find ways to add additional units, trying to maintain the structure of the community. So the thinking is not putting up massive high-rise apartment buildings, but increasing the density a little bit, adding additional one-family units by allowing an additional unit on a parcel in order to add more housing stock and address some of the affordable needs for the local community. It's a really big issue, especially in California, as you mentioned, just because the California home prices are just crazy high. You look at all of the major metro areas in California, and it's like sticker shock for people who are moving there from elsewhere in the United States. Median sales price in the San Francisco Bay Area is over $1 million. It's about $1.3 million in San Francisco, and that's the median price. So it's gotten to be very very hard to find affordable housing. A lot of challenges to constructing and adding new inventory. So movements like that to build or to permit ADUs where previously it had just been one unit zoning, I think is a really good attempt to try to add more housing stock, add more inventory to address some of the affordable housing needs in these local communities.
We have definitely seen ADUs every month that goes by as becoming a more and more common request or reason that homeowners are coming into RenoFi looking for renovation finance. It's definitely been surprising to see how much that's been growing. And it sounds like you don't think it's going to stop anytime soon, which I think is good for all of us. The last question I have is something else that we see that is, becoming more and more common, using the language from HGTV show, Love It or List It. We find more and more homeowners are coming into us who bought a home that they viewed was a starter home. They didn't see themselves in that home, for the rest of the time raising their family, but because of the housing stock inventory issues that you were alluding to earlier, they feel like they don't have a choice. The housing stock issues plus the 18% increase in housing prices have made it really hard to find a house that they could afford to quote unquote level up into. And so they decide to love their house instead of list their house, which obviously brings them to RenoFi, and we love helping those homeowners. There's a lot of talk about interest rates rising, the rest of this year and next year, with homeowners who have locked in extremely low mortgage rates. In a rising rate environment, it makes it even harder to list your house and buy a new one, because now you're moving into a much higher cost mortgage. How much do you see rates rising, and how much do you think that's going to impact just home sales in general in the coming years?
It's a really great question. And as you know, over the last year, we've had rock bottom, record low level of mortgage rates. I have to be honest, I never thought I'd never see 30-year fixed rate mortgage rates below 3% here in the United States. Well, it happened, and it happened for a whole year. For the last 12 months, the average rate on a 30-year fixed rate mortgage was 2.9%. And there were times when it was down around 2.75%. So incredibly rock bottom, record low rates. And we can't anticipate, we shouldn't expect mortgage rates are going to stay at this really unbelievably historically low level. The decade prior to the pandemic, the average rate on a 30-year fixed rate mortgage was 4.1%. And that was pretty low compared to historical levels of mortgage rates, even lower over the last 12 months. But that just underscores the fact that they're not going to stay at this level. At some point, the Federal Reserve will start to take its foot off the accelerator in terms of accommodative monetary policy, which is the fancy way of saying they're going to allow interest rates to rise, short-term interest rates as well as long-term interest rates. Our expectation is that over the next 12 months, we'll probably see 30-year fixed rate mortgage rates rise about 0.5 percentage point. So in round numbers, currently roughly about 3% is the average rate for a 30-year fixed rate loan. So think in terms of about 3.5% as the average interest rate a year from now. So rates are going up. They're going to be higher than the rock bottom, record low levels of the past year. But compared to historical levels, even if rates go up to 3.5% next year, that's still pretty low. Again, the average rate over the decade prior to the pandemic was 4.1%. So if we go up to 3.5%, I know it's higher than it has been the last year. It's still a historically low level.
Awesome. Well, Dr. Nothaft, thank you so much for chatting with us today. We're so lucky to have you on, talk about home equity, renovation, the real estate market, all of our favorite topics. It was a total pleasure to meet you.
Yeah, nice to meet you too, Justin. Yeah, great conversation.
Really appreciate it. And if you're listening to this and you're one of those home buyers who is reeling in this crazy market, you're not alone. RenoFi is a great way for you to purchase a fixer-upper and immediately be able to renovate. Or if you're a homeowner who's in that love it or list it and decides to love it, and you want to tap into that equity of your house, RenoFi is the right place to start. Make sure to keep an eye out for CoreLogic's report next month, and stay tuned for renovation financing solutions from RenoFi in 2022. Follow us on LinkedIn at RenoFi, or for updates at RenoFi Now on Instagram.